Welcome to ETF Market Insights, a weekly show focusing on the evolving world of ETF investing. Each Friday, a new panel of thought leaders aims to provide investment education and insights, with the goal of helping you become an informed investor. Make sure to visit youtube.com/ETF Market Insights to watch previous episodes. And remember to hit subscribe so you receive a notification when we post new content and when we go live each Friday. Thank you for joining us today. Let's get started.
Welcome back to ETF Market Insights. I'm your host, Erin Allen, VP of Online Distribution with BMO ETFs. Today, we'll be talking about financial wellness and personal finance. So a bit of a broad topic, but we'll talk about some ways that Canadians can improve their financial literacy and make smarter decisions when it comes to some of these longer term financial goals. So on the channel, we obviously cover ETF literacy and education every week, but I wanted to try something a little bit new. So I encourage you to share this video with anyone in your family who needs a little bit help around financial literacy. I think it'll be a great resource and hopefully you enjoy it. So as always today, a quick reminder, we're not providing investment advice or recommendations. Our show is all about providing education to individual do-it-yourself investors here in Canada. So today I have the pleasure of being joined by two fantastic speakers on the topic of personal finance. I have Fred Masters, who is the author of Lessons on Mastering Money, formerly a finance teacher who has a real passion for education and really looks to educate that next generation on money and all things financial wellness. I'm also happy to have Kornel Szrejber on today, host of the Build Wealth Canada podcast and also co-founder of the Canadian Financial Summit, which is one of the largest online personal finance summits here in Canada. So Fred, Kornel, thanks for joining me. It's good to have you here.
Great to be here.
Thanks, Erin.
Great. Yeah, good to have you back, Kornel. I thought we could kick things off and sort of give you guys both the chance to tell us a bit about your background and how you came to be where you are today. So Kornel, maybe we can start with you.
Sure, that sounds good. So it all started when my wife and I, we actually ended up fully paying off our mortgage when I was 29. So we were able to actually pull that off in 6 years. And that was a pretty nice event. It got a bunch of news coverage, things of that nature. But as wonderful as that was, after we became mortgage free, it dawned on me that I really didn't know much about investing, and that we are now in a way behind on our retirement savings since we were pumping so much money into the mortgage before. I wouldn't do it the same way over again, knowing what I know now, but that's pretty much what happened. And so at that point, I thought it would be neat to start a podcast and interview some of the top experts in Canada when it comes to personal finance and investing, but specifically here in Canada. So that was over 8 years ago. And then since then, it's become one of the largest personal finance and investing podcasts in Canada. I've done hundreds of educational interviews on the subject now. And then the lessons learned from that podcast and actually applying them allowed my wife and I to become one of Canada's youngest retirees at the age of 32. So that was a nice big milestone as well. And then these days, I just continue to run the Build Wealth Canada podcast. I interview the top experts, again, to learn the best practices in investing and personal finance in Canada. And the content continues to be really just exclusively for Canadians. So you never have to worry about some strategy or tactic, whether it applies to you. Because if you listen to like a US podcast, you're always kind of wondering, okay, does that apply to us Canadians? We have different taxes, we have different products, different things of that nature. So in this case, it's all Canadian stuff all the time. And yeah, so I hope everybody checks it out. It's Build Wealth Canada. Thanks.
Yeah, homegrown podcast. I think you cover so many great topics on it. And I just love the breadth of it, really. Like any topic that you can think of under the sun, you've basically hit. And there's
awesome.
How many more years are you going to be doing this for? There's so much more to go. I was on a few weeks ago talking about active versus passive and talking about a lot of the SPIVA data from S&P around active versus passive. So
yeah, that was fun.
Check that out. And Fred, why don't you tell us a bit about your background?
Well, great to be here, first of all, Erin, and to be with you too, Kornel. So I'm Fred Masters, and as Erin mentioned, I'm a retired professional educator. I taught senior personal finance for 3 decades with the Waterloo Catholic District School Board. And during the course of that time, especially towards the latter part of my career, I really started to notice that kids were feeling it financially. So I had senior students in grade 11 and 12, and what I started to notice was they were working huge hours. And what I mean by huge hours, like 30, 35 hours a week. And I was blessed to teach great kids, and so they were often in management positions at a very young age. And so you're talking closing at fast food restaurants at 3 and 4 in the morning. And so I thought, you know what, I can help them. I can create a little personal finance club, teach them some personal finance. So I created a little lunch and learn club, a little bit of a risk. You never know how that's going to go over. Never know if kids want to learn about something outside of the classroom. But they came, and they came in waves, and I put on over 100 of those sessions during the last 5 years of my career. And then staff started to come. And so this was really my epiphany. I was then asked to go up to the board's wellness committee and speak to that group, and they asked me back again. So at that point, I knew that I had enough content and I had enough passion, and there was certainly a need. And so I retired early and launched my company, Masters Money Management. I then started to present all over. So what I quickly learned is there's an insatiable appetite to learn more about personal finance across all demographics in the country. So primarily I've spoken to universities and young alum and current students. So I've done 13 presentations for schools like Western and Laurier over the last 3 school years. And during the midst of those presentations, I realized that I had enough content for a book. So I wrote, as Erin lifted up, Lessons on Mastering Money, the Personal Finance Guide for Canadians in their 20s and 30s. And the book received some great recognition. It was named as one of the top personal finance books in the world by an organization called the Money Awareness and Inclusion Awards in 2022. And I'm now a writer for Canadian Money Saver magazine. So it's been an exciting journey. As I often share, I'm still doing exactly what I love to do, which is teach others about personal finance. I just don't have to do any marketing, and I don't have to do any report cards anymore.
Yeah, take vacation whenever you want. That's great. I think your book is a great gift for anyone who's looking to send their kids off to university. Like, start with this book, because it does have a lot of really helpful hints in terms of financial habits, which sort of brings me to my next question. Obviously, you teach a lot about personal finance, and this is a loaded question, but what are the financial habits that you see as the key to success for this younger generation of investors?
Yeah, I wrote a whole book on it. So you're right, there's a lot in there. So I'll try to unpack a couple of pieces for our listeners. So I would say the first thing would be to really get a sense of what your personal finance goals are, and then get after them. And the reason I encourage people to do that is because if you think about it, a little bit of math, in order to reach or accumulate long-term wealth, there's really only 3 variables. That's the money that you have invested, the amount of time that you leave it in there, and your rate of return. And of those 3 variables, the time is the most powerful one. So there's a reason why Albert Einstein said that compounding interest is the 8th wonder of the world. So, you know, I like to use the term likely in my book, in my presentations. If you likely want to retire at a given age, if you likely want to help the kids with their post-secondary costs, then those are costs you see coming. And so we want to get after them. We want to start saving those dollars as quickly as we can, and want to invest in a prudent way for long-term growth. And we want to do it together. This is an absolute key piece. Talk about the concept that you want to talk to your honey about money in the book. And the reason is we're talking about decades of sacrificing here. And you really want to be pulling on the same rope with your partner. Many of us, of course, journey with a life partner. And I like to share the story that although opposites may attract, folks with opposite mindsets usually struggle financially on their journey, because you really want to be on the same page. If you're going to be sacrificing for decades, this is not a get-rich-quick scheme. If you're going to be sacrificing for decades, you want to have those goals in mind, you want to go together, and you want to support one another, because it's going to be difficult. So those are some of the key concepts I like to stress with our young adults.
I think you also had a really good point about, you know, it seems simple, but just don't leave the financial decisions just to someone else, right? Or at least be at the table and get involved as much as possible. A lot of times we see our parents where one spouse is just managing the money, and we think that's normal, but it's, you know, you need to be there and remain educated on those types of things.
Yeah, it's fine to delegate. We delegate all the time, right? We delegate financial and household responsibilities, and delegating your financial responsibilities to your life partner and advisor is fine, but you've got to be at the table. And the big piece there, you've got to be comfortable being at the table, and you've got to know enough to be able to financially thrive, not just survive.
Kornel, anything to add in terms of what you've learned in your journey in terms of the best habits for personal finance?
I think just tracking and having specific objectives can be very effective. I remember when we were still paying off the mortgage and fresh out of school, we had that objective where we said, okay, what if we only lived on one salary and then use the other one to either save or invest? And so by having that goal, it really helped kind of steer us in the right direction, as opposed to just kind of, oh, we'll see if we have any money left over at the end of the month. We'll see how it goes. Just kind of being very lax with it. Instead, we had a very aggressive goal in terms of saving, and we were motivated to do it because we thought, hey, if we paid the mortgage off early, we wouldn't have to see this money disappear every month. This would be amazing. Think of what we could do with that money, that kind of a thing. And so I think that alone was a game changer. And then we would, tracking the income part was pretty easy. The tracking expenses, there's all kinds of different tools out there now that you can use to track, just to see kind of, are we slipping in any area? Are we overpaying in any area? Are we trending in the right direction? You know, maybe we start overeating too much at restaurants, things of that nature. So there's lots of different things of that nature. But I think, yeah, it's much easier to hit that success if you actually have a goal and you're aiming for it, and it's something that you're passionate about hitting, and then also the whole tracking component, as opposed to just kind of let the cards fall where they may, and hopefully it works out.
Yeah, got to keep track of it for sure.
Mm-hmm.
All right, and then switching gears a bit, housing prices remain elevated. I just bought my forever home right a couple years ago, right before rates started to rise, unfortunately, but it's very difficult for young adults to enter the housing market. So Fred, you have a bit of a message to those in terms of people looking to buy a home right now.
Yeah, absolutely. So this is another one we've got to be on the same page with our partner, just the amount of dollars we've got to accumulate for that down payment. But I like to encourage our young Canadians to view their housing experience as a journey. You know, you're not going to get into your forever home. So there you are, Erin, just getting into your forever home. I didn't get into my forever home well into my late 30s. You know, your journey may look like starting off living with mom and dad and accumulating a down payment, and then perhaps renting for a little while, and then maybe a condo or a small property, and then maybe a larger, you know, attached something like a townhouse or maybe a semi, and then a detached. So it's a journey, and the reality is that whatever journey you're on is your journey, and that's absolutely fine. You know, we feel a lot of pressure to keep up with our friends, and for some reason there's a lot of emotional baggage connected to our housing, isn't it? So we feel like we haven't arrived unless we own a home, which is absolutely crazy. So your journey is your journey, and it is a lifelong journey. So don't be in a rush to try to get into that forever home. I mean, if you're house rich and poor in lots of other ways and can't afford a lifestyle that you're pleased with, you're going to regret that decision. So view your journey as just that and go together.
Regretting it right now, Fred. And then
Erin, I was laughing when you said forever home, because I remember every time we bought a home, we said that was our forever home, right. And then it never ends up being the forever home.
Forever for now. Yeah. There's always that debate over rent versus buy. So I'd love to get your guys' thoughts on that as well.
Sure. Do you want me to go first, Fred?
Sure, Kornel, jump in.
Sure, yeah. So I think one of the biggest mistakes that some people can make when it comes to deciding whether to buy or rent is just to be convinced that one of those is always the best answer, no matter the situation. So just being like a zealot about, okay, you always have to buy or you always have to rent. It's actually a very situational decision based on many, many different variables. And I would say that the optimum answer from the financial side can be completely different depending on the actual specific location where you would like to live. So in some parts of Canada, it is a lot more economical to rent, while in others it is a lot more economical to buy. And I realize that not everybody wants to do that math, but I think it's a critical thing to do, considering that this is probably the largest purchase of your life up to that point. But generally speaking, I would say you definitely do not want to purchase a home if you think you're going to be moving anytime in the near future. This is a mistake that I know I made when I was in my early 20s. This is because those transaction costs are so high when it comes to selling your property, for example, the real estate agent fees, the legal fees, just to name a few. And one critical mistake that I see some people make is that when they are crunching the numbers, whether they should buy or rent in a particular area, is they forget to include some critical expenses that come with owning a home. For example, they might forget about property tax, or they may understate that. That alone can be very substantial. There's recurring repairs, there's major repairs like the roof, the furnace, air conditioning. All of that needs to be factored in. Utilities as well have to be factored in, particularly if you're used to renting and those tend to be covered in your rent, like it is in some places, and now you have to pay for the water, the gas, the electricity. That can all actually make a pretty substantial amount. So I find too, what makes this question really challenging as well is that even if the math says that you should buy or you should rent, there's also that whole lifestyle or psychological component as well. So, after you do the math, it may say that, yes, in this particular area, maybe it makes sense for you to rent, but maybe you want a type of property that is not available to rent and are okay paying more for that because it's a lifestyle decision at that point. Maybe you get some peace of mind and you like that stability of having a home, let's say with a fixed rate mortgage, for example, instead of worrying about rent hikes or being forced to move by the landlord, things of that nature. Or maybe you love a particular area and you really want to live there, but you just simply cannot afford a home there due to how expensive it is over there, right? So in that case, you may be forced to rent even though you don't really want to, even though economically maybe that's not the best decision if we're just looking at purely dollars and cents. So, really, I think it's about actually doing the homework, evaluating the pros and the cons, both from a quantitative side, but also from that qualitative, lifestyle side, and then making an educated decision, realizing that there are pros and cons to each one, and then making an educated decision that way.
For sure. Anything to add to that, Fred?
Yeah, I would just add briefly that if you've decided to rent long-term, that's absolutely okay. You need to unpack some of those emotional baggage that comes with that decision. If that's your decision, that's 100%. But I would throw one caveat on the table, and that is that home ownership is really a way to accumulate wealth over the long term. If you think about what you're doing is every month or every bi-weekly pay period, you are paying off some debt and building your equity. And so at the end of a 20-25 year amortization period, what you've got is a lot of built up wealth in that property that you can unlock when you retire. So you may be in a position where you don't have a lot of pension savings or retirement savings, but you look at your home as your fund to finance your retirement. But if you're a renter, you don't have that. So if you are going to be a long-term renter and buying real estate isn't in your future, then you need to be absolutely vigilant about saving for retirement, because you're not going to be able to tap into the equity in your home. So that would be something that I would absolutely encourage your listeners to embrace.
That's some good insight. Thank you. And then switching gears again, BMO recently had a survey that they put out, I think it was a few months ago, where they found that Canadians are now expecting to need $1.7 million to retire. And that's up 20% from 2020. So I'd love to get your thoughts on this, whether you think that's realistic and what are some ideas in terms of how investors might actually get there.
Sure, yeah. So definitely I want to acknowledge that. I can see how that can be a stressful thing for Canadians. Inflation has outpaced salary growth for many Canadians, which is a cause for anxiety for a lot of people. But I do caution people, I think, to not just use general blanket numbers. So for example, saying that we all need 1.7 million to retire now, and then stressing out about how we're going to hit that because, I'm not, maybe you're not even at $1 million yet. So how are you going to possibly get to 1.7, right? So I'll just give you an example. So on my podcast, I've interviewed guests who want over $100,000 a year to spend in retirement. And then I've interviewed others who are actually living on $50,000 per year, and they are completely happy. And so in this example, if one couple wants double than the other, then obviously they both don't need a $1.7 million portfolio. The size of the portfolio needs to be dependent on how much you want or need to spend in retirement. So this is why I think it's critical to actually work with a financial planner who can take into account the different variables that can change that number specific to you. And I think a good financial planner should also be running different scenarios in their financial planning software. For example, what if we have average market returns versus above average performance versus below average returns over your time frame? They need to be able to stress test your portfolio and run different assumptions and see how you would fare in each scenario. And then from there, you can actually come up with a relatively accurate, or as accurate as one can be, best course of action in terms of how much you actually need to save now for retirement. So I definitely strongly advise, I would say, against simply using a simple rule like a specific percent or an absolute number as like the number to aim for based on how you feel or what you think. This is obviously a very complex subject. Taxes are complicated, as we all know, and they keep changing as well. So we need to actually be running these numbers in a financial planning software with a certified financial planner that can actually help us get it right, specific for our situation, instead of comparing yourself to someone that maybe wants twice as much income in retirement as you, and then panicking like, how am I possibly going to hit that portfolio number? Well, maybe that doesn't apply to you. Maybe because you have different needs, different wants in retirement.
Perfect. And anything to add to that, Fred, maybe in terms of, how some habits to get you to your retirement goal, whatever that may be, if it's not 1.7 million?
Yeah, so boy, here I'll draw a parallel for you. So my younger son is an athlete, he's a runner. And so he just completed the Ottawa Half Marathon 2 weeks ago. So let's view the race day as retirement date. Well, he started training for that in September. So even though he's an elite athlete, he started specifically training for that event 8 months in advance. And so another example of likely, I really think there are 3 big financial tests that we've got to cope with as Canadians. We've got to get 100% on this test. You've got to figure out retirement funding, whatever that may look like for you. You've got to figure out housing. And if you have kids, you've got to figure out some way to help them with their post-secondary costs, because we want them to launch. And they also want to launch. We don't want them to boomerang back. We want them to go. So we've got time. We want to get started, just like when my son started to train for his marathon. We want to get started. So I talk extensively in the book about this earn, save, invest cycle. We want to be in a position doing work we love and taking additional qualifications and credits to put ourselves in a position to get some pay raises. We want to automate our savings program. We can't just haphazardly save. We have to save every 2 weeks. We have to do it with a partner if that's our circumstance. And then we want to invest those dollars for long-term growth. We want to use tax sheltered accounts. Kornel talked about this, and it's significant. We want to invest dollars inside our TFSAs or our RSPs to accumulate those dollars over the long term. I'm a big fan of TFSAs because the dollars are tangible and you can understand them. We all have a $6,500 annual TFSA limit for those who are 18 and over for this year. If we take that amount divided by 26 pay periods, that's $250 a pay period. We want to save as much as we can, as close to that $250 goal. We want to automate that saving every 2 weeks, get those dollars into that TFSA and invest for our retirement, because we're going to have to retire. Your future self is going to love the fact that you started doing this today, 10, 20, 30 years down the road when your retirement comes, because retirement's going to look like lots of different things potentially, but one of the things you're going to have to do is rely on your money to finance those events as to you actually working and having to go to work.
For sure. Start early, get that compounding by investing regularly. And I like the automate point too, because then your emotions and your excuses are not getting in the way, right? During the pandemic, we definitely saw a lot of these younger investors getting started in the investing world, which is great, but we also saw them sort of getting involved in these meme stock crazes and crypto, turning to social media platforms. What are your thoughts around this?
Yeah, so this is something I saw during every one of my university presentations. I would have a Q&A at the end of the sessions, and I'd get a crypto question every single time. So I always talk about, get rich slow, invest using index investing, don't pick stocks. There's so many other risks that you embrace if you start selecting individual stocks. And then we get a crypto question. I actually had to take the content and put it into the presentations. So concentration in work or in school is a great thing. We like to be able to concentrate, but it's dangerous when it comes to investing, because what it does is it puts too many eggs in one basket. We want to diversify, we want to embrace diversification, and we want to be in a position where we're avoiding stock picking. So we want to embrace global index investing. We want to own the entire planet, and we want to do it in an asset allocation way. So there's a proper mix based on our age and our risk portfolio of equities versus fixed income. And we want to do that for the long term. And again, for a young Canadian, we're talking decades here, because what that's going to do is avoid you being swayed by those strong emotions that accompany us when we invest, and that is fear and greed. You don't want to be going to a party this weekend or a barbecue and hear about some cousin who's making a killing on AI stocks. That is not what you want to hear, because again, there's risk there. Piling into a sector, piling into a company increases our investment risk. We want to mitigate risk. We put our seatbelts on when we hop into the car. That's mitigating risk. There's danger when we're in a car. We want to mitigate risk by using diversification. By the way, the Canada Pension Plan Investment Board does this in a big way. If you hop on the CPIB and have a look, they invest using index investing in a global way. So the pros do it, we should be doing it too.
Yeah, I think it exposed some cracks in what we've been doing to really educate that next generation. That's what this did for me. And I think you guys are both doing a lot around this. And can get in front of them sooner, then maybe they won't have these horrible, well, maybe not always, but sometimes horrible experiences as their first time investing, and may, grow to love it.
Yeah, I really like your example there, Fred, about the cousin or whoever at a party talking about how they did so well on some AI stock, that kind of thing. And that can be really tempting for people, I think. And I think it happens a lot because it's a fun sort of dinner party conversation. But what I always tell people is that that same person is not going to tell you when they actually lost money doing speculative investing, right? And so you kind of hear the good stuff, you hear the highlights, you don't hear the negatives. They could be down tens of thousands of dollars for the year through bad speculative investing, but your only thing you hear from them is the positive thing, and so you think they're doing great, but really they don't. So I definitely hear you, and I think that's a concern. But yeah, to answer your question, Erin, this whole thing does actually worry me quite a bit because yeah, so much of it is just based on highly speculative investing, and a lot of it too, I've noticed, not in all cases, but a lot of times it's being promoted and endorsed by people who don't necessarily have the education and qualifications to teach what they are teaching and to make the claims that they're making. And again, I'm not saying everyone, but there are definitely a lot of these get rich quick self-proclaimed gurus out there, and so that does concern me, and I worry that some beginner investors, they see this and they think that this type of investing, the speculative investing, is the only way to go, not even knowing about or not even considering something like passive index investing through ETFs, for instance. And then kind of to your other point about the bad experience, they may have a bad experience and then they may decide that investing is just not for them, that is just too risky because, hey, I tried it once. This happened to some people that I know, or a friend, and it happened to me, in a way as well, although it didn't turn me off from investing. But where you have this kind of, you're told by somebody you trust, that you believe that something's going to do well, it's a highly speculative thing, it goes to zero or drops significantly, and then now in your head at a young age, like I was in high school at the time, now you're thinking, oh, this investing thing is pretty risky. I might lose all my money if I invest. So do I even want to do this at all? And that's not all that investing is, right? There's passive index investing. It's not like all companies are going to go bankrupt overnight or something like that. So just that does worry me, that there are people that may sort of get that sort of an impression and may get the wrong image of what investing is and only think that there's just this one path. And so I think I'm a parent, and I think it's our duty to really educate our kids of the other forms of investing so that they're not swayed by these sort of get rich quick narratives that seem to be really pervasive these days.
And Fred, you sort of touched on the importance of an index-based approach. We talk about that a lot in your book as well. And of course, it depends on the individual circumstances. But are there talk to us a bit about the ETFs that you think are a good sort of foot in the door for a lot of newer investors?
Well, let's talk about the ones that aren't, first of all. So you mentioned some of the SPIVA work that's been done by S&P around index versus value and active investing. Here's the reality, that over the long term, again, these are all long-term goals, right? So we're not talking about saving for university in 2 years. We're talking about saving for the big stuff. So we're talking about stuff that requires decades of investing. Over the long term, Canadian actively managed mutual funds underperform the index. And the index is just like a class average, just like the compilation of the results of the stocks that are in that particular index. But over the long term, actively managed Canadian mutual funds underperform the index. And the reason they do that, of course, is because of heavy fee structures. Over the long term, a 2%, 2%, 2%, 2% management expense ratio, year after year after year, eats results. And so here's a sobering conclusion. If you find yourself in a position where maybe your advisor has put you into a batch of investment funds that are actively managed, you are likely underperforming the index and paying a lot of money. You are overpaying for underperformance year after year after year. And so we want to break that cycle. And the way to break that cycle is to not try to beat the index, but just to buy the index. And we can also do that in a super cheap way. One of the things we can control in terms of investing is our fee structure. And we can select index products that have rock bottom fees. And that's a great way of controlling costs. And over the long term, that is a key success factor in terms of reaching your financial goals. I love, as I mentioned, I call them global index products, global balanced index products. They're asset allocation products. They're anchored on index investing. And over the long term, they will provide fantastic returns. You're going to get the index average of the long term. You're not going to beat the index, but again, the vast majority of professional money managers don't beat the index. So it's a great approach. We embrace all kinds of advantages like diversification, keeping fees low, avoiding urges to be swayed by fear and greed. Over the long term, it's a great approach.
Yeah, and you know, what you mentioned, avoiding emotion, I think the rebalancing feature is huge too on that, because it just keeps you on track to whatever, whether it's a conservative portfolio, balanced, or growth that you've selected. It'll keep you on track and keep you within that risk level, which is going to help you with that emotional side of investing for sure. I'm going to link in the comments the SPIVA report because we've mentioned it a couple times. So we'll put that there for any of our viewers who want to take a closer look at that as well. Kornel, you have a very disciplined approach to investing. You do focus on passive investing, but you've talked a lot on your podcast and in interviews about the different tools that you use. So I thought it would be good to have you highlight some of the resources that you've really leaned on in your journey.
Sure. Yeah. One of my favorite ones is actually Morningstar Canada. And the reason I like it, and I'm not affiliated with them in any way, I just like their tool. The reason I like Morningstar Canada is because you can look up funds like a particular ETF, let's say. And what's unique about them in particular than a lot of the other financial sites I see out there is that they'll actually give you a total return. So not just the capital gains or losses, but your capital gains or losses plus the sort of the dividends as well. And so I really like that because that's what you ultimately care about at the end of the day. And so I do like that. And I think that's maybe a common mistake that some people make is they compare two investments and they say, oh, well, this one grew way more than this one, so this one must be better. Well, not necessarily if you're not factoring in any income. Maybe one has a very high yield, let's say, and the other one doesn't, right? And so having that total return number, I find to be very valuable. The other sort of tool that I use, and I'm going to give you a shout out here, Erin, is the BMO ETFs you guys have. So I do consider the asset allocation ETFs to be a really, really good investing tool. I personally buy ZEQT. I'm a high sort of equity investor, so I personally use ZEQT for my kids' RESP. I find that to be really good and that suits my needs. So yeah, definitely a big fan of those with the automatic rebalancing. And I'm glad you guys have one as well, because I remember there were times where I was looking for it and didn't exist, and now you've had one for a while. So it's been great. I've been using it ever since you guys launched it. And then the third tool that I use quite religiously, actually, it's called Passive. It's spelled PASSIV, so just passive, but without the E at the end. And there's really two main things I use it for. It's basically a tool where it's linked to all of my investment accounts. And so like me personally, I have 8 accounts for our whole household. I have 3, my wife has 3. Then we've got, RESP, we've got the corporate account. So lots of accounts. Instead of logging in and out of each account to see how we're doing and then adding them up just to see how much our investments are currently based on the current market conditions. Here I can actually see them all in one spot, in one view, which is really, really nice. So that is wonderful from a convenience standpoint, just to know where we're going from the reporting. And then the other thing that I use it for is for pretty much automatic rebalancing. So you still have to click to have a rebalance, but you can basically rebalance your portfolio. And I counted once, I think it was 2 or 3 clicks. I think it was 2. So really, really neat, because before this tool existed and before I was investing before asset allocation ETFs became so popular, back then I had to do everything in a spreadsheet. So I created a fancy spreadsheet and I would plug in all the inputs, and then it would tell me how much I have to, when I have, let's say, X thousand dollars to invest, it would say, okay, buy this much of this ETF, this much of this, and this much of that to get you back into your balance, right? And so it was all like manual entry. And of course there could be human error because if you make a typo, so I'm always triple checking the work. It was a hassle. And so now with a tool like this, it's linked to all my accounts. And then it says, okay, you told us what you want to buy. You told us the asset allocation you want. So you have X dollars to invest. Okay, so we're going to buy this much of this one, this much of that one, and then click here to actually buy them. And so I click that button and it buys all of them. And so it really has saved me dozens of hours at this point, just from it's fun in the beginning to, I guess, learn all this, even do it manually, just so you understand the calculations and all that. So I guess that that's still okay. But now I'm like, okay, I've been doing this for so long now that I like the automation piece a lot more. So yeah, so I would say those are the 3 that I probably talk about the most on the show.
Not everyone has all that time to do all that research or has the desire to do so. So that's a great tool to highlight for sure.
Yeah, for sure.
All right. Well, Fred, Kornel, I want to say thank you for joining me today. That wraps it up. I really enjoyed our discussion a lot. I wish we had longer, only half an hour here, but hopefully we can have you back in the future to continue this discussion. So thanks again.
Thanks for having me on.
That caps off another great week of ETF Market Insights. Next week, I'll be back. I'll be joined by Larry Berman from ETF Capital Management. You might recognize Larry's name from his show on BNN. He was really a pioneer in Canada as one of the early portfolio managers to adopt ETFs in portfolio construction. So he takes a bit more of a tactical approach to investing with ETFs. So it'll be really interesting to hear his views on the market and where we're headed next week. So thanks again for joining us, and we'll see you next week. Bye for now.
Thank you for watching this week's episode of ETF Market Insights. To stream any previous episode of ETF Market Insights series, please visit youtube.com/ETF Market Insights. Remember to hit subscribe and sign up for alerts so you know when we post new content. Also, we invite you to visit our accompanying website for ETF tools, education, and much more at etfmarketinsights.com. Once again, thank you for watching. The session provided is for information purposes only. Any reference to a particular company or product is for illustrative purposes only and should not be considered as investment advice or recommendation to buy or sell. Particular investments and/or trading strategies should be evaluated relative to the individual's investment objectives, and professional advice should be obtained with respect to any circumstance.